Well, hello everyone, and welcome once again to 5 Homes to Freedom. We are in Module 3, Lesson number 2. So in Module 3, we've got 6 lessons all together. Lesson 2 is the effective timing of payments. So what I'm going to do is actually walk through a live demo. I'm going to use the mortgage analyzer to show you the effect of what having monthly payments is, which means 12 months a year, which most people are familiar with. That's how I think the vast majority of mortgages are set up that way. Versus semi-monthly, where you just take the same payments, but you do it over, not the same payments, you split the payment in half, do it over 24 months, and that's usually connected to makes it easier for people to budget because a lot of people are paid semi-monthly as well, so it's tied to their paycheck. We'll then take a look at the effect of doing it bi-weekly and weekly as well. Now, I've already gone through the examples, and I'll do the live section for you here in a second, but I just wanted to show you the effect of the numbers. You may want to take a pencil and just write down the balance owing. So for example, here the balance owing after 1 year is $291,234.96. So this is the way most mortgages are set up by default. Unless you ask otherwise, they're going to set it up as a monthly payment. So with a $300,000 mortgage at 2.5%, with a amortization period, and that again, that's the life of the mortgage, that's 25 years, our monthly payment is $1,343.90. And again, the balance owing after 1 year of making all your payments is $291,234. So you've reduced your mortgage payment by $8,766, give or take. Now, if we change that monthly payment to a semi-monthly payment, so we've taken our monthly mortgage payment and split it in half, and we're making payments twice a month, people are under the assumption or led to believe that the mortgage balance is going to be paid down more quickly because you're giving the bank more money sooner. So it would make sense that that it would do that, but actually you can see the year one balance is $291,235, not a big difference at all. And then when we go to biweekly, our biweekly payment is $619.92. And the reason why it's not changing here, well, when we go to weekly as well, you'll see that the mortgage balance is barely changing at all. It's not worth your while. And actually, making weekly, bi-weekly, or even the semi-monthly payments is a pain in the butt for scheduling sometimes. And if you're not having any positive effect to your balance owing, then why bother doing it? Keep it at the monthly rate. So what the banks do is they take the mortgage payment that you're making over the course of the year, and they just divide it by 52 weeks. So you're really not making any more payments. You're actually just spreading the same payment out over a longer period of time. So here's a quick summary of what the mortgage balance is for each of those different payment methods. So as you can see, it's only changing by $1 at the very most here and there. So there's no real benefit. Now, before we move on to the next slide, I just want to bring up the analyzer so you can actually see in real time what I'm talking about. Okay, so here's our monthly payment. Our loan amount's $300,000, 2.5%. We're doing this in Canada right now, so it's semi-annually. If we were in the American market, it would be done as it says here. Whoops. Anyways, yeah, it would be done monthly. So for the amortization period, 25 years, our monthly payment is $1,343. Now, if we take the payment frequency and we change that to semi-monthly, keep an eye on the outstanding balance up here. Up here is what the number I want you to look at. So when I change it from monthly to semi-monthly, it goes from $291,234 to $235. It actually goes up a little bit. If we go to bi-weekly, It changes again, but very, very slightly. And then weekly. So there's not really a whole lot of benefit of doing this. The only benefit of doing it is when you increase the actual principal pay down portion of your monthly payment, which is what we're going to take a look at in the next slide. So as I said, what they normally do is they'll take your monthly payment of $13.43 per month, which works out to just over $16,000 annually. They'll divide that number by 52, and that's the $310. That's where they're going to get their weekly payment from. When you take the monthly payment though and you divide it by 4 weeks, it actually comes up to $335.98. You then apply that into the weekly ratio, and you're increasing your payment by just over $25 per week. Then you're increasing your payments by a total of $1,340. And the effect of that, so again, here we have our regular payment, which is $13.43. When we increase it by that $112 extra payment, what I've done is I put that extra $112 down here. So instead of increasing this number, I've just increased it by placing it in here on a monthly basis. You can see that the mortgage outstanding balance has now dropped down to $289,875. So it's not because we're paying weekly or semi-monthly or bi-weekly or anything like that. It's because we are applying an extra payment every month. That's where the benefit comes in. And a lot of people think it's just simply because they're making more payments. It's really not. So the bottom line is that what the bank is offering or suggesting is a bit of smoke and mirrors. It's not the reality, and it's only beneficial if you take that monthly payment divided by 4 to generate the extra payments that is beneficial to you. So this plan that the banks are offering works well for those with no self-discipline. However, in this program, we just want to keep it simple. So what we want to do is simply add the monthly cash flow ourselves to either the monthly payments or use the lump sum method, payment method. So we set the money aside in a special savings account. So at the end of the year, we've got enough money that we can apply in a lump sum payment to reduce the principal owing to us. The principal owing to the bank, rather, sorry. So let's take a look at how this all plays out in year one. So in year one, what you're going to do is you're going to ask to have the payments increased initially. So if our initial payments are $13.43, based upon the calculations, standard calculations, we would like to have them increase those payments as much as we can, as soon as we can. Now, if we've got an additional $650 cash flow, they simply won't allow us to apply all of that $650 on a monthly basis. They probably won't even allow you to put $600 on it, because they're going to want you to have a certain amount of cash flow set aside in order to offset any costs, maintenance issues, etc. So they won't allow you to initially set it up that way. So you get it increased as much as you can, and then in month 2, what you're going to do is you're going to increase your payment immediately, because you're allowed once a year to increase your monthly payment by 10 to 15%. Depends on the mortgage documents, the lender, whether they allow you 5, 10, 15%. You then set the balance of your monthly cash flow aside to create your lump sum payment at the end of the year. Now, you could simply just keep all of the cash flow set aside and create the lump sum payment, but as you've seen earlier, it's much more effective if you pay down the debt, the extra cash, on a monthly basis versus an annual basis. Then in month 13, which is going to be the first month of year 2, you're going to go through that process again where you increase your monthly payment because you're allowed to do it on an annual basis. So you increase it by that same 10 or 15%, which will then reduce your monthly cash flow. But whatever that monthly cash flow is, you continue to set it aside and make your lump sum payment then at the end of the year. And obviously your cash flow is going to be a little bit smaller, therefore your lump sum payment is going to be smaller as well. So let's just take a look at some real numbers just to drive this home. So here we have the $300,000 mortgage at $1,343 per month. We're going to assume that our cash flow is $650 per month after the PITI, and that's your principal, interest, taxes, and insurance. These are the expenses that you as the owner of the property are responsible for. All other expenses you can download onto the tenant. So you've got $650 a month. Now we want to increase our mortgage payment by as much as we can. And when you do this initially, the way you do it is you actually decrease the amortization period. So you say to your bank, your loans manager, I would like to reduce the amortization from 25 years down to 20 years. The effect that has is it increases your monthly payment from $1,343 up to $1,587. And by increasing your monthly payment to $1,587, you've now decreased your cash flow down to $406. Then in month 2 of year 1, once you've made your first mortgage payment, you make your request to increase your monthly payment by whatever amount or whatever percentage you're allowed. I've used 10% just because it's an easy calculation. So our monthly payment currently is $1,587, so I just rounded that up to $159. That means in month 2, my new mortgage payment is going to be $1,746.82. Again, that's going to reduce my cash flow by another $159. So now my cash flow is only $247. And I'm going to take my cash flow for the balance of the year, which is 11 months times 247. So at the end of the year, I'll have approximately $2,700 to place against the mortgage in the form of a lump sum payment. And of course, this is assuming we've had no cash calls, no issues with the property. So that's it for the example. Actually, I guess in year 2, I should have just continued. In year 2, you're going to do the same thing. You're going to increase your monthly payment. You can't change the amortization anymore, but what you do then in year 2, month 1 of year 2, you increase it by another 10%, which reduces your cash flow by another $170, and you keep that lump sum payment then, although it be smaller, you keep that lump sum payment in a separate account. You apply that at the end of the year as well. That's how you can maximize your payments for your mortgage on just on one mortgage. Now you can do this on other mortgages as well, and actually when you play with the mortgage analyzer, when you've got 10 mortgages in a row, for example, it doesn't have to be 10, 5, whatever number of mortgages you have, you can look at mortgage number 1, go through this exact scenario that we have right here. But you might say, well, I've only got $2,700 to apply to a lump sum, and I'm allowed, I have a $300,000 mortgage. I'm allowed to put 10% down. That's $30,000. Well, maybe what you can do, you can take the lump sum payment allotment from your property number 2, 3, and 4, and you can apply it to property number 1 as well. And what that does is it pays down property number 1 faster. And as you pay down property number 1 faster and to achieve your financial freedom date with that one, it also improves the cash flow of that one much more quickly. And as soon as you've got that one debt free, you can then turn that profit into one of the other properties as well. Sounds a little bit complicated, but this is why you need to play with the numbers. Go back and listen to this one numerous times. The bottom line here is though that you control how you pay down the debt as quickly as you want. Don't fall into the trap of having to make bi-weekly or weekly payments thinking that you're going to be paying down the debt more quickly. The only way you're going to pay down the debt more quickly is if you are applying money directly to the principal, which is what the 5 Homes to Freedom strategy is all about. All right, so that's it for lesson number 2. Again, I'm sure this is going to generate lots of questions, and which is fine. But again, please hold off on your questions until we get a chance to go through the live webinar. And if they're not answered at that point in time, then as always, feel free to contact me at ken@5homestofreedom.com. All right, we'll see you next lesson. Take care.